Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Guys, the Treasury and Yellen has a choice. Default now or default later, or maybe crash now and crash later. We're going to talk about what that means in this video, so let's dive in.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Hey, it is holiday season and our holiday specials are running right now. Just promo code HOLIDAY. You already blew it. You missed the Black Friday specials, but this is your second chance to take advantage of some of the best pricing that we do for the year. Check us out, tradelikeagenius.com, tradegenius.co, tradegeniusacademy.com. All roads lead to Trade Genius. Check us out. Incredible deals. Thanks for listening.
All right, Bob. So, we know that the market has been benefiting from a lot of the T-bill issuance because that just is almost like cash going into the markets and getting injected, liquidity injections, almost like a form of QE, except it's not coming from the Fed because the Fed's bleeding and hemorrhaging money with their current situation, but it's really coming from the Treasury, which is a little odd because that's not normally the case. And you dug up some charts I thought was really, really interesting.
Yeah, Phil, you were in construction industry for a long time. Have you ever seen a subcontractor paint himself into a corner or lay down cement and realize they got to walk on it to get out of it? Well, that's what Janet Yellen did. And it kind of befuddles me that she shot the wad early because, if they're looking to be reelected, you think you'd want to save the juice to when people are paying attention. So I really don't know what's going on. And what I mean by that is they issued all these T-bills. And as you discussed, and we discussed in previous episodes of our podcast, is when they issue a T-bill, the money that's used is basically allowed to be collateralized for speculation versus if you do a T-bond, which then becomes a liability on your book, which it's almost kind of like, positive and negative gamma. So, Janet Yellen's creating juice with T-bills, but when she does T-bonds, it's almost like a drawback on liquidity. But now she has a situation where rates are going up. This next chart's wild. So we have rates going up, we got liquidity going down, and they're losing money now on the carry trade. So the Fed is broke, and now the Treasury is going to put themselves in a situation where they wouldn't be able to issue enough debt, and they may default. It's absolutely insane. Sorry.
Yeah. So, if we look, they're going crazy with bill issuance, and liquidity is also another issue where I think this is all going to kind of come to a head at once. And that's the problem, I think, is what we're going to see. And I think that manifests at the back half of January and down into March, where, she knows she only has so much rope left on that T-bill issuance schedule. And there's going to be a huge amount of the long end that still needs to be deployed in the first half of the year, which to me, it's been, like you said, you're kind of unloading this a little bit too early in terms of timing, especially if they're trying to look for things to look rosy into November. But, which is usually the game plan through all those election cycles, is always trying to prop up the market into whatever election's happening. So, the timing here is a little bit odd, unless, of course, they were worried that there was something else going on, and we know there's a lot of issues with the banks and, commercial real estate holdings are underwater and a lot of the bond holdings are underwater. So, is it a matter of, are they trying to just provide liquidity because the market so desperately needs it? And the side effect of that is a little bit inflationary because, asset prices keep rising. And that's the big question mark. So I think there's just a lot of, at this point, because of the move that we've had and the fact that she has to then pull back to an extent now on that issuance that's been fueling the market, I think there's a perfect opportunity. And seasonally, markets tend to pull back into March. And I think you just have an opportunity here, timing wise, to see a bit of a pullback and something that this market's kind of forgotten about since the beginning of the 2022.
Yeah, look, last week we did a lot of evergreen podcasts because we were both kind of traveling a little bit, and we didn't really address the market this week. Everybody expected these massive flows to come in the beginning of the year, and I think the market's sniffing out that it might be better for us to be prudent in getting out of the market. And that's been our worry all along. Since the 28th of December, this market's been in free fall. Today's Monday. We're getting a bit of a bounce. But the important thing that I want people to watch for is these correlations. Right now, if TLT is up, the market tends to be up. and oil tends to be down, and vice versa. And I think that's what you got to watch for. And if this scenario that Phil and I are talking about plays out, which I think physics requires it to happen, is that you'll see TLT fall again, and the market's going to go with it, because people do not want to be taking these losses. And if liquidity dries up at the same time, the sell-off can be pretty intense. You know, you thought we'd make it to the 5th. I thought we'd make it to the 15th. On the long side, we came out of the gate and we got blown right up right in the beginning.
Yeah.
You know, and so good thing we weren't trading much. Pretty wild. I was actually surprised. And I think they really set, Jam Croissant had everybody leaning into that bull in the beginning of the year with $2 trillion of flow coming in, and they basically front ran it and blew that trade right up. And that's not done yet. I mean, today might be an up day, but they're not breaking any of the moving averages that we need to worry about. It could just be another dead cat bounce.
Yeah, so like the daily 9 EMA is a short-term barometer, and we've kind of run into that. And I think what we're establishing now, just kind of some forward looking, is that I think we got a bit of a range into that January OPEX. But I'm very leery of things after that January OPEX, opposite of what we saw in November and the opposite of what we saw in December after that OPEX. And then again, that plays into seasonality. So I think that's where you got to be really careful. And I think we're going to be range bound into OPEX. Bob, I think that's my take anyway, going into the 19th of January, which is our January OPEX.
Yeah, and people need to pay attention to the 17th. That's when the VIX contract flips.
Yeah.
And you're going to get a basically backwardation in there, which is also negative. Look, I'm raising cash. And here's the thing too. Today they're blowing up energy, shippers, and biotech, and the only thing they're really carrying are the high tech, because of the show, Nvidia, Apple, and Supermicro. Everybody else is a little bit of a bump here and there, some short covering rally. So I'd be really careful. We're running out of sectors that are going higher, folks. So bear that in mind. Get defensive. Count your chickens here and count your blessings, and be ready for, I think, a pretty rough 6 weeks after this week's over.
Totally agree. Guys, let us know your thoughts in the comments below. Do you think this market is just going to go up and away, or are we pulling back later in the month, maybe all the way into March? Love to hear your comments below. Otherwise, guys, thanks for watching. Please hit like and subscribe. Check out our stuff over at tradegenius.co. If you need help navigating these markets, you can join us in the room over there, and we have ways that you can do that. Just check it out at tradegenius.co. Otherwise, Bob, thank you, and we will see you guys on the next episode. Take care.
Trade Genius.